So income taxes, we'll talk about the basic ideas of income tax, and then we'll talk about how to hand calculate tax owed using a table of marginal tax rates. All right, couple definitions that you need first off, right off the bat. Gross income. This is just all of your income for the year, including wages, tips, profits, interest you make from a savings account, dividends. Remember, those are certain stocks. When a company earns a profit, they pay out to their stockholder. So any income you receive. Then we have adjustments. So that's gross income that is not taxed. So if you make a contribution to a retirement account, that's what an IRA is, remember. Make a contribution to a retirement account, you get to take that out of your gross income. And there are some other tax deferred savings that maybe you can subtract out of your gross income. And so adjusted gross income is just that. You take your gross income and you subtract out your adjustments. Great. So the truth of it is probably nobody on the planet fully understands the federal tax code in the United States because it's thousands of pages long and constantly being updated on a yearly basis by Congress as they sign in, new laws. We're just going to get a general idea of how it works so that you can file your own taxes, which you should be able to do. All right, the next thing we have are exemptions and deductions. Those both get subtracted from your gross income. So exemptions are a fixed amount per person, and they can be claimed for you and each of your dependents. You guys don't have any dependents. You are dependents for somebody else. I have dependents. Those are usually children, or if you're primary care for like a senior citizen, right, or something like that, that can sometimes be considered a dependent. And then deductions will vary from one person to another. And you can choose one of two things. You can take what's called the standard deduction, and that'll be a fixed amount and depend on your filing status. And by filing status, I mean you will file as single or married, filing jointly. All of you would be filing as single. Or if you don't choose the standard deduction, you can do an itemized deduction, and that'll be, you'll have a list of individual deductions that you'll add up. But you only get to do one or the other. All right. So now we get to the definition taxable income. This is literally your income that is taxable. It's the income that the federal government will tax you on. And the way we calculate that is we take your adjusted gross income, we subtract exemptions and deductions, and then we have your taxable income. So then let's talk about tax credits. Generally, they are more valuable than tax deductions. A tax credit reduces your total tax bill by the full amount of the credit. So I'm going to go back for a second. Once you have your taxable income, this is what you're computing your tax bill from. Okay, so this is the number that we're going to compute your tax bill from. Now, we have what's called a marginal tax rate. So it's not as simple as what's called a flat tax. A flat tax would be like, hey, you're going to give me 40% of your taxable income every year. And so let's say your taxable income is $1,000. You're going to give me a 40% of that. That's $400. Boom, right off the top. But that's not the way our tax system works. And we'll talk about the way ours works. But once you compute what your actual tax bill is, let's say it's that $400, the way tax credits work is they come off your tax bill. So this is why they're better than tax deductions. Tax deductions come off that taxable income. So tax deductions would come out of this. Tax credits come directly off your bill. So the way you can kind of think about it is it's like a coupon versus a gift card. A coupon gives you a certain percent off of your bill. A gift card is actual money towards your bill, if that makes sense. All right, so let's go back. So tax credit reduces your tax bill by the full amount of the credit, whereas a tax deduction only reduces your taxable income by the amount of the deduction. And we'll do some examples that hopefully help to clarify that. All right, and your total tax, which is like, this is the amount due, is your tax computation minus your tax credits at the very end. So you can think of the tax computation as your tax bill before credits. Yeah, for sure. This one is a lot of definitions, but it is important stuff. And so we're gonna compute a few tax bills by hand, which is not something you're really going to do probably. There's tons of good free online tax software now, but it is important that you understand how it works. And the tax credit stuff is especially important. One of the most important things is every person gets a $400. What do they, Aaron? What do they call the education tax credit? Oh, just education tax credit. So it's like in Arizona, you get a $400 education tax credit, or 200 per person. I think we get 400 because we file jointly, so we get 200 per spouse. But what that means is you're allowed to just donate $400 to any educational entity, so like to the school, and you get that $400 back in a tax credit. So all that's doing is I can give ASA $400, or I can give my kid's school $400, and that'll come directly off my tax bill. If my tax bill is zero, then that means the government is going to cut me a check for $400 at the end of the year. So it's really important that every year, when you have the opportunity, you do use that for $200 tax credit and donate it to an educational entity that you feel deserves it, because you're going to be paying that money anyway in taxes. All this does is allow you to direct it exactly where you want it to go, right? So it's just allowing you some autonomy over how your tax dollars are used in that case. So we usually do, I think, like 200 to ASA and 200 to my kids' school. But we'll talk more about credits as well. All right, let's move forward. Here's a table that I strongly recommend you pull down, right? I posted a PDF of the slides, but this is one that I usually print out in a normal school year, and I give to my students and allow them to use it on the test. Because yes, it's important that you understand what these terms are, but this is complicated enough. You're gonna want to have this information. It tells you exactly sort of the flow chart of how you prepare your taxes. You start with your gross income. You subtract adjustments, and that gives you your adjusted gross income. You take that adjusted gross income, you subtract deductions and exemptions. That gives you your taxable income. Then, this is the part that we're going to do. You're going to make your tax computations, and this is going to give you your tax bill. Once you have your tax bill, you'll subtract off any tax credits, and then you get the total tax. This is what's due. So that's what you have to pay the government at the end of this. Now, most jobs automatically deduct taxes for you, right? Unless you are self-employed, or, you know, if you're like work a job that you're paid out in tips, then they don't. But most will. So once you know what's due, then you can subtract off, oh, hey, but I've been taking out blank % of my paycheck, every paycheck, and putting it towards taxes. So I've actually already paid you what I owe you, government. Then you subtract that off. Once you've done that, if the government owes you money, they'll cut you a check for it. That's called a tax refund. If they don't owe you money and you still owe them money, then you have to cut the check yourself to the government. So that's the amount owed or your refund. All right, we're going to follow this flow chart for a couple examples. Let's talk about Karen. Karen earned wages of $38,200 and received $750 in interest from a savings account and contributed $1,200 to a tax-deferred retirement plan. She was entitled to a personal exemption of $3,900 and to deductions totaling $6,100. Find her gross income, adjusted gross income, and taxable income. All right. I don't have a lot of space to work with here, so I'm kind of going to write around my page. Apologize for that. But her gross income is just everything she's earned that year. So it's her $38,200 plus her $750 in interest. And that's it. That's all of her earnings that year. So that's $38,950. There we go. That's her gross income. All right, adjusted gross income. So let's go back and review what that is. So it's just gross income minus adjustments. Remind you of what adjustments are. That's any income that's not taxed. So contributions to retirement accounts or other tax-deferred savings. So Karen contributed $1,200 to a tax-deferred retirement account. So we're allowed to take that out of her gross income. So subtract the $1,200. She's not going to be taxed on that. All right, so that's $37,750. There's her adjusted gross income. All right, and then we'll do taxable. So we're going to take her adjusted gross income, the $37,750, and we're going to subtract off deductions and exemptions. All right, so the deduction, she had an exemption of $3,900 and a deduction of $6,100, so we're just going to subtract both those off. So minus 3,900 minus 6,100. It's 28,550. So this is the amount that the government is allowed to tax Karen on. That is her taxable income. Okay. So now we'll talk about filing status. So your tax calculations will depend on your filing status, which consist of the following 4 categories. That means you're single, you're unmarried, you're divorced, or you're legally separated. Married filing jointly. That just means you're married and the 2 of you are going to file a single tax return. Married filing separately, that means you're married and your spouse and you file separate tax returns. Why do they have different categories for those? Well, there can be tax implications if you, say, own your own business and it's under your name and not your spouse's name. Sometimes it just makes more sense to file separately in cases like that. And then there's the last one is head of household, and that means you're unmarried and you're paying more than half the cost of supporting a dependent child or a dependent parent. So remember that I said you can either choose to itemize your deduction or take the standard deduction. And the standard deduction is a flat rate that the government issues. And they say, hey, the standard deduction is, in this case, $6,100. But you can itemize deductions for things like charitable contributions, interest on a home mortgage. You can take a deduction on, but you only get to do one or the other. So you only want to itemize if your deductions add up to more than what the standard deduction is, right? So the standard in this case is $6,100. If you itemize you had $2,500 for interest on a home mortgage, $900 for contributions to charity. So that's why, like, when you go to Goodwill and drop something off, they'll be like, do you need a receipt? Because they can give you a receipt and you can write down how much your donation was worth. And then if you're going to itemize, that's basically your proof. So if the government audits you, because you go, oh, I gave like $1 million in charitable donations, then you have to have proof of that. All right, and then $250 for state income taxes. So that adds up to $36.50. And since you can only do one or the other, you're going to want to take the standard deduction. Yeah, you can itemize one year and do standard the next, absolutely. But you can only do one or the other in any given year. All right, so what we have is called a progressive income tax, and it just means that people with a higher taxable income pay at a higher tax rate. No, I guess I had a video in there last year. But I have this, I'll go back to that. I have this kind of chart that I thought was a good visual of a progressive income tax because people really struggle with this idea. And you'll hear like progressive Democrats, like Bernie Sanders wants to tax billionaires at 90% or whatever. But that's not a flat tax. That doesn't mean the government would take 90% of their money. That means they would take like whatever, 90% of the money they make above $750 million. So that's going to be a very small amount of people. And it's not taxing their money, all of their money that way. So this was some British person did this, which is why it's written in pounds instead of dollars. But the idea works the same. So people incorrectly believe that a 40% tax, marginal tax, means you will pay a total of, in this case, £40,000 in tax if you earn £100,000. That's not the case. This is called a flat tax. So the way a progressive tax works, if you earn $100,000, and this may be what the British categories are. This is not the same as ours, but you pay 0% on the first $12,500 you earn. Then you pay 20% on the next $37,500 you earn. So that's £7,500 in tax. And finally, you pay 40% on the last $50,000 you earn. So that's an additional $20,000 in tax. So you're only actually paying $27,500 in tax, pounds, not £40,000 in tax. And that's roughly the way that our progressive tax works as well. The categories are slightly different, and I'll show you what they look like. But it's the same idea. So we call those marginal tax rates, and they're assigned to different income ranges or margins. All right. So the textbook I used for this class was published in 2015. And so what we're using is the 2013 marginal tax rates and there's standard deductions and exemptions. Now those have changed, but not by a ton. Everything's still pretty close to this. So for the sake of this class, we'll just be using this table. And I'll give you like excerpts from this table when we take an exam. All right, and so you can see the 4 categories of filing status are given in these 4 columns. Now, generally, everybody is going to be paying in each category up to the highest category that they belong in. Now, when you're talking about taxes, you say your tax rate based on the highest rate of taxes that you pay. So let's say, just because 100,000 is an easy number to work with, let's say you make $100,000 and you're filing single. So we're looking at this column. What tax rate would you say that you pay at? Which tax rate do you belong in? And when I say that, I'm saying, what's the highest tax rate that you will belong in? Throw it in the chat. Help me out here. What's the highest tax rate that you'll pay in if you earn $100,000 and you are filing single? So I got 125%. So the answer is actually 28%. So notice that it says up to. So you are going to be paying at the 25% level, but that's for people who earn up to $87,850. You earn more than that. So some of your money is going to be paid at the 28% tax rate. Does that make sense? So you make more than $87,850. So you will still pay at these three tax rates, but you'll also pay the last, whatever 100,000 minus 87,850 is. What is that? That's $12,150. So you'll pay the last $12,150 will be paid at the 28% tax rate. All right? This was as of last year, what our tax categories looked like. So slightly different numbers, but roughly the same, okay? That's just to give you an example of where we're at now. We're still going to use these 2013 numbers when we're actually making calculations on homework and in exams. Yeah, the last administration changed a couple of things as well. So notice that here the standard deduction was $6,100 and the exemption was $3,900. The last admin raised the standard deduction for married couples to $24,000. And $12,000 for single filers, but it got rid of the personal exemption. So it basically doubled the standard deduction, but got rid of the personal exemption, which had little to no impact on everybody's personal taxes. All right. So again, let's talk about tax credits versus tax deductions and why tax credits are better. Remember that tax credits actually come off your tax bill. Tax deductions come off your taxable income that you use to calculate your tax bill. So you're in the 28% tax bracket. How much does a $1,000 tax credit save you versus how much does a $1,000 charitable contribution save you, which is tax deductible? And it says answer these questions for the cases in which you itemize deductions and for the case in which you take the standard deduction. All right, a tax credit will save you that $1,000. It's like a $1,000 gift card, like I said. It comes off your tax bill. If your tax bill is zero, that $1,000 tax credit turns into the government owes you $1,000 and they will cut you a check for that $1,000. So a $1,000 tax credit saves you exactly $1,000. So if you itemize that $1,000 deduction gets taken off of your taxable income. So all that means is that you're not going to be charged at whatever your tax rate is for that $1,000. That doesn't save you $1,000. All that saves you is whatever percentage of 1,000 that you are being taxed at. So you're in the 28% tax bracket. If you itemize and deduct that $1,000, it's going to save you 28% of $1,000. Which is $280. So if you itemize your deductions, then that $1,000 charitable contribution will save you $280, which is 28% of the $1,000 you donated, basically. If you don't itemize, that means you took the standard deduction, then that charitable contribution saves you $0. Because again, you either choose to take the standard deduction or you choose to itemize, not both. So in either case, a tax credit is much more valuable than a tax deduction. Okay, so Drew is in the 15% marginal tax bracket and Marion is in the 35% marginal tax bracket. They each itemize their deductions and they each donate $5,000 to charity. Compare the true costs for their charitable contributions. So if they each itemize, then they get to save whatever percent of $5,000 that they're paying at their highest marginal tax rate. No, there is, well, Colin asks, will we see an example where itemizing is better than a tax credit? There is no case where itemizing is better than a tax credit. Tax credits are more worthwhile. There is cases, maybe this is what you're asking, when itemizing is better than taking the standard deduction that the government will give you. And that's just when your charitable contributions or your charitable contributions plus, say, money you paid in interest on a home mortgage add up to more than what the standard deduction is. That's when you'd want to itemize. This example, though, is a good example showing how it's actually easier for rich people to donate money and costs less than it does for people who make less money. So if Drew is in the 15% marginal tax bracket, that means at most he's making what? He's making less than $36,250, right? And Marion is in the 35% tax bracket. That means she's making somewhere more than $398,000, but less than $400,000. So she's much better off than Drew in terms of her income. But let's see how that's impacted if they both donate $5,000 to charity and they both itemize their deductions, meaning they're going to save some money off of that $5,000. And the money they're going to save is going to be whatever their tax rate is, that percent of $5,000. So Drew saves 15% of $5,000, which is $750. So Drew saves $750. That means the true cost of his $5,000 donation was really only 5,000 minus 750, because the government basically paid 750 of those $5,000 he donated. So it truly only cost him $4,250 to donate that $5,000 to charity. But Marion, who makes much more, and donated the same $5,000, gets to save 35% of her $5,000. Which is $1,750. So her true cost is 5,000 minus the 1,750. Which is 3,250. Whoops. So Drew, who makes less money, both of them donated $5,000. Marion makes much more, but it only actually cost her $3,250 to donate $5,000, whereas it cost Drew, who makes much less, $4,250. Cost Marion $1,000 less to donate $5,000 to charity. All right, Social Security and Medicare. Everybody pays this. And they are called Federal Insurance Contribution Act taxes. They're taxed separately at a flat rate. FICA taxes apply to income from wages, including tips, and self-employment, but it does not apply to income from interest, so from money that you've earned from a savings account, or dividends or stock. So basically not income from investments. You don't get taxed by FICA on that. All right, let's do an example. So in 2013, Jude earned $26,000 in wages and tips from her job waiting table. Calculate her FICA taxes and her total tax bill, including marginal taxes. What is her overall tax rate and her gross income? Including both FICA and income taxes. Assume she is single and takes the standard deduction. All right. So I need to give you what the FICA tax rates are. So I'll just write that at the top of this. The FICA tax rate, whoops. is 7.65%. All right. So just to compute the FICA, that's going to be 0.0765 times Jude's entire $26,000 income, which when we multiply that out comes out to $1,989. All right, so that's Jude's FICA taxes. So now we're going to see fully how to calculate her total tax bill, including marginal taxes. So we're kind of going to use that flow chart. So we're going to start with Jude's gross income. Which is $26,000. It doesn't say that there are any adjustments to be made. She didn't contribute anything to a retirement account, anything like that that we can subtract off. She takes the standard deduction, so we do want to go back and look at that. She's filing single. Standard deduction is $6,100, and she also gets a $3,900 exemption. So we are going to subtract those off. So minus 6,100, and then also minus the exemption, minus 3,900. And that's 16,000. All right, so now here's where we're at in terms of our flow chart. We started with the gross income. There were no adjustments, so the gross income was also the adjusted gross income. Then we took the adjusted gross income, we subtracted exemptions and deductions, and now we're at the taxable income. So now we're ready to make our tax computation based on rates in our tax table. So she has a taxable income of $16,000. So that's going to tell us what her highest tax rate will be in our tax table. FICA is not included in the tax computation. It is separate. So it's a separate tax. All right. So what tax rate, what is the highest tax rate Jude would be paying at if she has a taxable income of $16,000? Good. Colin says 15%, and I agree. That's true. So she does make more than $8,925, but she makes less than $36,250. So the highest tax rate she's going to pay taxes at is 15%. So we would say that Jude is in the 15% tax bracket. Now, again, you progress your way up the tax chart. So here's how it works when we calculate total tax. She's going to pay 10% on the first $8,925 that she pays. All right. So the first $8,925, she's going to pay at a 10% tax rate. So I'm going to multiply that by 0.1. for 10%. Now, the 15% is the highest tax bracket she's in. So she's going to be paying 15% on the remaining money that she hasn't already paid taxes on. She's already paid taxes on $8,925. She only needs to pay 15% on what's remaining, which would be her $16,000 minus that $8,925. So that ends up being 0.1 times that 8,925 plus 0.15 times $7,075. And so here's the thing to remember. When you're doing a tax calculation by hand like this, when you add up the money next to the tax brackets, those should add up to the taxable income. And in this case, they do. If you add 8,925 to 7,075, you get the $16,000. That's her taxable income. All right. So now I'm just going to pop this in the calculator, and we're going to get our final tax bill. So 0.1 times 8,925 plus 0.15 times 7,075. All right, and that's $1,953.75. So that's her total tax bill. Well, I should say her total, this is her total marginal tax bill, or her income tax. Then if we add that to her FICA, so if we add these two, we would end up with $3,943. All right. We're getting towards the end here. Dividends and capital gains are treated slightly differently than normal income. So things you make from investments basically get special treatment. So dividends are just profits paid out on stocks, and capital gains are profits that you make from the sale of stocks. And there are two kinds of those. There are short-term capital gains and long-term capital gains. Short-term are profits on items sold within 12 months of their purchase, and long-term are profits held for more than 12 months. Hold on one second. Okay, my iPad just died, so I just have to share this with you on a different screen. Last thing. Tax deferred income tax deferred savings plans allow you to defer income taxes on contributions for certain types of savings plan, and they include the following: individual retirement accounts, qualified retirement plans, and 401ks. So those were the things that we would subtract off, right? When we're calculating our adjusted gross income, you would take your total income and then any money you contributed to a 401k or an IRA, you get to subtract off of your gross income, and it's not going to be taxed.